Hello everyone, welcome to this session. So in the previous session, we have seen how a central bank using open market operations and discount window affects the monetary base, and then through which we are going to see how money supply is going to change in today's session. So what we are going to discuss here is that the multiple expansion of deposits and its impact on money supply. So I'll first show you a motivating picture. So what you can see here is that this I have shown you in the previous session as well. So you can see the money supply, that is the currency in circulation plus deposits with the banking system, that is the money base, and the monetary base, that the one we discussed in the previous session, where using open market operations and discount loans it affects the monetary base and through the banking system. And this picture, what you can see that the size of the base is small, relatively small as compared to the total money supply. So what does it mean that if a central bank does open market operation or discount loans, making discount loans to the banking system, what it can do that it can influence the reserves or it can influence the currency. But what you can see here is that, but that is only this, the size is this much, but the total money supply is this much. So that means from this picture what you can see that the money supply is greater than the monetary base, whereas a central bank can only influence the monetary base, which is at the bottom of this figure. So here, how based on this much the small, relatively small monetary base, there happen to be a large money supply or money stock. So this happen normally through the multiple expansion of deposits with the banking system. So in order to explain this concept, let us continue from the previous session. Assuming that, suppose that a $100 open market purchase made by Fed was conducted with the first bank. Just with this a starting point, this is one of the commercial banks. So in other words, we are starting from open market operation where the central bank purchase a government security from a commercial bank, and then in return the central bank credits $100 in the account of the particular commercial banks. So then what is going to happen here, this we have seen earlier as well. So you can see the first bank, the commercial banks asset side, there is a decline in securities, but there will be an equivalent increase in reserves. So reserve, we have seen that is the monetary base. So from this example, to make the idea clear, you can see that there is an increase of monetary base, that the reserve by that is reserve. In fact, there is an increase in reserve by $100. So that means the monetary base has increased by $100. In other words, you can also see the reserve has increased by $100. So now first bank give this reserve, this $100 reserves as a $100 loan to a borrower. Suppose this particular bank, why should they sell government securities to the central bank, and in return it gets currency? So obviously it wants to use this money for some productive investment. So here what it happened that this $100 it got credited to this bank. Now this bank loan out this the equivalent amount of money to a borrower. So when it does like that, what happened that the first bank's T account in the balance sheet, you can see that first this remaining same, securities decline, reserves increase. Now what happened that these loans have increased. When the loans have increased, what you can see that this reserve disappear. So and similarly you can see the checkable deposit, there is a change in checkable deposit as well. Before that, what you can see that in this first bank, first bank, you can see that the securities has declined, reserve already increased. When they make a loan to a borrower, how this commercial bank will loan out this money to a customer, not that the loan amount will be deposited in that customer name. That means it will be deposited in that customer name as checkable deposit. So that's how a commercial bank gives loans. Then it's up to the customer if they want to withdraw this money or not. So it will be immediately deposited when the loan is sanctioned. Immediately it will be deposited in the customer's accounts. So you can see that loan has increased, and similarly on the liability side, checkable deposit has increased. So when we translate this one, what you can see here is that this reserve will not stay with the first bank for very long. Suppose now that the borrower purchase goods and services from other individuals and corporations by writing checks deposited in another bank, or just spend the money, and those who get it deposit with another bank. So you can take bank A or bank B. So then how does the first bank, the First National Bank which we discussed just now, its balance sheet changes? It changes in this way. The securities already declined and there is an increase in loans. So its asset side, it now contracts to securities and loans, decline in securities by 100 and loans increase by $100. And since the customer has withdrawn this amount, so it's actually disappear from its liability. That money is already taken away by the customer. The money is already taken away by the customer. Now let us see. There will be multiple expansion of these deposits. So bank A who got this money, what happened in their T account, in their balance sheet. So now the storyline is open market operation by the central bank with the First National Bank. Then the First National Bank loan it out, and that money now comes to bank A. Then in this bank account, the assets, their balance sheet assets increase by $100, and liability also increased by $100. If someone deposit this check with the bank A, how they will enter it in their T account? So because this money coming from a check, then they need to get this money through the central bank. So it will be credited in this account, in commercial bank account by the central bank, and then central bank later on it will be deducted from the other bank who issued this check. So on the liability side, checkable deposits increases by $100. Checkable deposits increases by $100. So that means it will be credited, this much amount will be credited in the depositor who deposited this check here. Now suppose this customer, he or she doesn't withdraw this money, just keep it as checkable deposit there. So if the required reserve ratio is 10%, if required reserve ratio is 10%, then bank needs to invest this money elsewhere, because it needs to pay interest income to this customer, and also it has surplus fund now because it has now $100 with it. So then the commercial bank will want to loan out this money to another customer or firm. So but it cannot lend the entire amount, but it can lend only 90%, because the required cash reserve ratio is 10%. So what does it mean? It means that of the total deposits received by any bank, be it demand deposit or time deposit, a certain fraction has to be kept with the central bank. Assuming that for the sake of simplicity we took it 10%, that means this bank can lend, it can utilize only the remaining 90% of the fund, and the remaining, assume here is the 90% of the fund, it will be loaning out to another individual. Then obviously there will be a natural question to you. You will be thinking that why the First National Bank didn't keep 10% as required reserve? Because the required reserve ratio is mainly on the deposit it receives from the general public. but the First National Bank got $100 not from any deposit from the public, but by selling government securities to the central bank. That means the money directly received from the central bank by selling government security to the central bank. So it's not through any deposit. So it doesn't need to keep 10% as the required reserve. But here Bank A has to keep 10% as the required reserve, and the remaining 90 it can loan out to another an individual or firm. So let us look at here how the banking system, its liability and assets change using a T account. So initially you can see Bank A, initially reserve increased by 100 and checkable deposits increased by 100. This we already discussed. Now when it's giving loan of 90, then the asset side changes in this way. 10, that is the 10% is reserved with the central bank because that is the required reserve, and the remaining 90 is the loan to an individual. That is also an asset. So you can see that this $100, now this is an asset for this commercial bank, but distributed in two parts. One is assets with the central bank, one is reserve with the central bank, and second one is loans given to an individual. So on the liability side, it still remains same. That means $100 is the liability. So then Bank B, suppose this person withdraw this money, then Bank B, the person who got this money or make some transaction to maybe another individual, and that individual go and deposit this money with another bank, that with Bank B, then immediately what you can see that the Bank B, the third bank in our discussion here, its reserve increased by 90 because the deposit is made here through a check, and then its liability also increased by 90, right? Because it immediately credit this much amount of money in that individual's checkable deposits. Then assume that here, suppose the money deposited with Bank B, this customer is not withdrawing this money and prefer to keep here as a checkable deposit. Then what the bank will do, that this bank also now needs to lend out this money, and assume that this also loaning out this money. Then what it has to do, because it got received a deposit of $90 here, that is the deposit. So out of that, 10% should be kept as reserve. So remaining $81, that will be given as loan. So that means the total asset is again 90, but distributed between reserve and loans as 9 plus 81. So on the liability side, you know that immediately on that individual's name, it becomes a liability for the commercial bank in the form of a checkable deposit. Now let us assume that the person who got this money, $81 as the loan, makes buy some goods and services, may buy some capital goods or buy some durable goods, and then this money goes to another individual, and that individual deposits this money with another bank, for example Bank C. So if the borrower puts the loan in Bank B, this bank will only be able to give loan excess of 81, which already we discussed. But what happened that if this money goes further, the checkable deposit would increase so far by the total amount of 271. So that means First National Bank, Bank A got 100, Bank B got 90, Bank C got 81, Bank D got 72, and then some more money again another bank, Bank E will come, but it has to keep 10% as the reserve, remaining can be loaned out, and Bank F comes, Bank G comes, G, H, I, J, we can keep on add like that. If all banks make loans for the full amount of their excess reserve, further increment in checkable deposit will continue as this way, that the 190, 81, 72.90 plus like that it will keep on going until this money vanishes. So if you present this one in a table, the increase in deposits, it will be First National Bank, there is no increase in deposit because it got $100, but through open market sale of their government securities to the central bank. But Bank A, their deposit has increased by this, Bank B increased, Bank C increased, Bank D increased, E, F, it increased. Finally, if the reserve ratio is 10%, from this table, what you can see that the total deposit increased by 1000. So you see here that the monetary base in the beginning, monetary base increase in the beginning was 100 through an open market operation. But you can see here is that the total increase in deposit is 1000. So you can see here the increase in loans 1000 and increase in reserve is 100 here. So if you present this one, the process, the increase in this money with the Bank A, Bank B, you can read it in this way. It increased by the times, the reserve times 100, reserve times 1, that is this one, and reserve times this, this. And finally, if you sum up, what you are going to see, the sum of an infinite series is equal to the total increase in del, that is this increase in del is equal to del R. Del R is the reserve that it came to the banking system, that is $100. We have seen through the open market operation, we have seen $100 has reached the banking system. That is this R times 1 divided by 1 minus again 1 minus R, and finally this would read like that: del D is equal to del R, that is the 100, times inverse of the required reserve ratio, that is inverse of 10%. So what you can see here is that inverse is here 10, 10% of inverse of the 10% is obviously 10, and you can see that if the cash reserve ratio is 10%, when a central bank does an open market operation with a commercial bank by buying, purchasing a security and equivalently and injecting equivalent amount of money in their account in the form of reserve, all transaction will be in the form of reserve here, injecting that much amount of money in the form of reserve. Then that one would lead to this much increase, the 1 by inverse of the reserve ratio times increase of that reserve, then it will lead to, you can see that from this, it will lead to 1000 here. So here, this 1 by the inverse of the required reserve ratio, this is considered as the simple deposit multiplier. So the point here, you are in the motivating figure, we have seen the figure, we have seen the monetary base is small, monetary base, we have seen that MB is C plus R, but money supply is equal to C plus D. So mainly we have seen multiple expansion of deposits here, and that not directly, not solely by the central bank, but also by the banking system also participate in this. So this is how the money supply is in general greater than the monetary base. So here the multiple increase in deposits generated from an increase in the banking system's reserve is called the simple deposit multiplier. So more generally, the simple deposit multiplier equals the reciprocal of the required reserve ratio. So this is the formula for that, and using the illustrative example, we have explained this one, how an open market operation or any monetary policy initiative by the central bank, it leads to a larger increase in the money supply in an economy. However, this simple model, there are some criticism against this model, because many assumptions that we made here are actually very brave. It won't hold true in the real world. For example, currency holdings. So the actual creation of deposit is much less mechanical than the simple model indicates. Because what I assumed here is that somebody took a loan, $100 or 90 or 81. We assume that the person doesn't keep any amount of money, any cash with them. They deposit the entire amount with the another bank. That is not true. But if they keep more currency, then there won't be this much multiple expansion. Similarly, about the excess reserve. So our assumption here was that the banks do not make excess reserve, but in the real world, banks do not make loans or buy security in the full amount of their excess reserve. And if banks choose to hold all or some of their excess reserve, then the full expansion of deposit predicted by this model doesn't occur. And here, Fed, the central bank, is not the only player whose behavior influences the level of deposits and therefore the money supply. It's actually the depositor's decision, how much they would like to deposit, whether they would like to deposit or not. Do they trust the banking system or not? If they don't want to keep the money with the money that they got from the bank, if then that money, if they don't want to keep with the bank at all as a deposit, that also matters. Then the multiple expansion chain stops at that moment. Similarly, bank's decision, the amount of excess resource to hold. If they think that all the money, the open market operation, the $100, it came to them, they don't want to loan it out and they just want to keep the entire amount as excess reserve. So from that moment onwards, the multiple expansion of deposit stops, right? Then there won't be, then the monetary base and the money supply will be same. So the factors that determine the money supply, one, the changes in the non-borrowed monetary base. If the money supply here is positively related to the non-borrowed monetary base, if through the open market operation or there are more money comes to the central bank, then from the point that we discuss here, the chain that we discuss, multiple expansion of deposit, through that route money supply increases. Similarly, if a commercial bank borrow from the central bank, obviously that is the borrowed reserve, that also, then the reserve with the banking system increases. Then from there, you know that the depository expansion of the deposits takes place. Here money supply also, money supply is here positively related to the level of borrowed reserve from the Fed. But there are three other factors that is inversely or negatively related to the money supply. That one is the required reserve ratio. If central bank increases the required reserve ratio, instead of 10%, if it increases to 20%, then you can see the money, the deposit multiplier that you are going to get, instead of 10, it's going to be 5. And similarly, changes in currency holdings. If general public would like to hold more currency with them instead of depositing with the commercial bank, then also the money supply, the multiple expansion of deposit declines, then so do on the money supply as well. Then similarly, changes in excess reserve, the point that we discussed. Because excess reserve normally serve as a cushion or insurance against losses due to deposit outflow. So normally commercial banks, they prefer to keep a certain fraction of their deposit as excess reserve. So if the commercial bank keeps more amount, more portion of their deposit as excess reserve, then that also are negatively related, because that one won't go to the banking system and it won't go to the general public, right? Then the money supply will decline. So this one can be better explained using another concept called money multiplier. Is called much expanded form of the simple deposit multiplier to overcome its limitations. So again, just to set the stage, I show this figure again here. So this one is the monetary base and this one is the money supply, and using this monetary base, there will be an expansion of money supply this much. So what you can see here is that the expansion in the total money supply are divided by the monetary base. So when this monetary base expand to this, so it expand by a multiple times, a multiplier. So that multiplier is the multiplier, the value of this multiplier, money multiplier, is money supply divided by monetary base. So simply we can define money supply as money multiplier times the monetary base. and of which a central bank has control over the monetary base. It doesn't have, in that way, it can influence the money supply, but it has more control over the monetary base, not completely on the money supply. So in order to derive the money multiplier formula, we need to define some of the factors that affecting money supply besides the monetary base. One is currency deposit ratio. The depositors' decision about their holding of currency and checkable deposits are one set of factors affecting the money multiplier. Second one is the required reserve requirements imposed by the Fed or the RBI on the banking system. So if it changes the required reserve, we are going to see if it changes how it affects the money multiplier. Then the excess reserve, the bank's decision about excess reserves also affect the money multiplier. So in order to derive this one, we can rewrite the currency deposit ratio. First we can, this one is C, the small letter C is the currency deposit ratio. That means currency, the total currency divided by the total deposits in the economy. This is the required reserve ratio. That means total reserve as part of the total deposits. Then the excess reserve, that is the excess reserve divided by total deposits. We can rewrite it as this way as well. This will be useful in deriving the formula, multiplier formula. So here the beginning, always remember MS is equal to C plus D, MB is equal to C plus R, and money multiplier is equal to MS divided by MB. MS divided by MB. So then each part, MB means C plus R plus C plus R, then you need to elaborate it as R is RRR plus ER. So rewriting this one, you can rewrite MB as in this way, because we already have rewrite the equation specifying RR, ER and C in this format. And finally monetary base can be rewritten that the ratio, the sum of all this ratio times D. Then rewriting this one, money, the monetary base we have rewritten like this. Then dividing both sides of the equation by the term, then we get D as inverse of this, that is the inverse of R plus E plus C times monetary base. Then using the money supply definition here, we can replace, interchange the values here, like money supply is equal to, because this one C into D plus D is equal to this. So here substituting in this equation the expression for D from equation 2, we have MS equal to 1 plus C divided by R plus E plus C times MB. So that means M is this one, because this we already see. Money supply means we have already seen money supply is equal to M times MB. So accordingly this becomes the money multiplier. So money multiplier is M is this 1 plus C divided by R plus E plus C. So here the induction, let us examine the induction behind the money multiplier. Suppose these are the values given, then plugging these values in the formula, you will get the money multiplier as 2.5. So the money multiplier 2.5 tell us that a $1 increase in the monetary base MB leads to a 2.5 increase in the money supply. So that means if there is an open market operation, OMO, through the OMO, by the central bank through OMO, for example, $100 increase is there, and this would lead to increase in money supply by 2 times. That is, there will be a 250 times the increase by 250. If there is an open market increase by $100, the increase in money supply is going to be 250, that is 2.5 times. So I also give some instances, insights here. When there is changes in R, how money supply is going to change. So I have some text here. I'll just show it to you. You can go through this. When R increases from 10 to 15%, and if you plug this value in the formula, then money multiplier become 2.3 from 2.5. That means it declines. Then similarly, if C increases, then again you can see that it increases. The currency deposit ratio, currency holding increases. Then that means here, if it increases from 0.5 to 0.75, then money multiplier decline to 2.06. Similarly, changes in C. Here also you can see that is going to decline by this. So what we have discussed in this session is that we discussed how a central bank using open market operations and discount loan initially they influence the reserve with the banking system, and then using the multiple expansion of deposits, we have seen that the deposit in the banking system increases, and thereby money supply also increases. And in the money supply increase, in order to get a better clarity, we elaborated this one and expanded the simple deposit multiplier formula to derive a money multiplier formula. So there at that time, we have seen that if the central bank reduces, for example, the recurve reserve ratio, then the money supply declines. So that's also another monetary policy tool. In addition to open market operation and discount loan, here the central bank use the recurve reserve as another monetary policy tools to affect the money supply. So if they want to increase the money supply, then they reduce the recurve reserve, and if they want to reduce the money supply, they increase the recurve reserve. And thank you for watching this session, and see you in the next session, and thank you.